Hello and welcome to the final Wealth of Advice market update recorded on the 15th of December 2022. I'm absolutely delighted that this is the final market update we're doing for this year. It has been a very bad year for investments. Every client who invests in a managed portfolio, Royal London portfolio, anything across the board has had a very difficult year. We've had so much come at us from an investment point of view: rising interest rates, rising inflation, China being locked down virtually all of the year. Obviously the huge story at the beginning of the year was the war in Ukraine that hasn't ended. And as I say, markets haven't been good this year. However, what we're going to try to do for you today in this update is show you what positive green shoots are coming through, and hopefully 2023 is a much better year for all of our clients, and as I wholeheartedly believe that because the data is now starting to come through to show this could be the case. So we said at the top there, although 2022 hasn't been a great year and I can't wait to put it in the bin, there are definite reasons to be cheerful about what 2023 may offer us. If you go back to the beginning part of this year when Russia invaded Ukraine, all the news channels were telling us that we were going to end the year with this huge energy crisis. I'm obviously not suggesting people's gas and electric bills and petrol and diesel costs haven't gone up. They have. It's been very inflationary what's happened. However, this energy crisis of being blackouts, of us running out of power, hasn't materialised. 88% of EU gas storage is currently filled. That's obviously as a result of a mild autumn. I know we're having a very cold winter right now, but 88% of EU gas storage filled is massive. Mr. Sunak, our latest Prime Minister, the 3rd of 2022, he recently struck a gas deal with the US. So the US are going to supply the UK and lots of Europe as well with huge amounts of gas in 2023. It's funny how that kind of unfolds where Russia invades Ukraine, we expect an energy crisis, Nord Stream 2 pipeline going to Germany is blown up a few months ago, and then all of a sudden everyone's buying the gas from the US. So that will benefit our clients' investments, whether it's Royal London, whether it's our model portfolios, because we do have a big exposure to the US. So that will reflect in positive growth in the companies that are affected there. And obviously from our point of view, you have to start asking MPs and other people in power, these high energy prices that individuals are paying and businesses are paying need to come down, because we have a great supplier of the gas, and as I say, we have so much in reserve. So that is a definite positive, that we end the year feeling that we aren't going to have an energy crisis that we thought may be happening back in February, March time. So here in the UK, inflation, we believe, has now peaked. Figures came out a few days ago which is suggesting it's still extremely high, but it has gone down from the previous month. That's great news. You then look at UK petrol prices, which is a great barometer of what people were feeling at the middle part of the year when prices shot through the roof, when you were paying over £1.90 for a litre of petrol. That has come down. People will argue that it's still too high. The oil companies are profiteering. Yes, 100%, they're bang at it. Supermarkets, any forecourt you go on, I think are charging more than what they really should. But if you're the CEO of those companies, you're going to get away for it as long as you can. And then when you see a particular garage suddenly reduce the price, people are there en masse. But that inflation with regards petrol and diesel is coming back down. Let's hopefully see that continue. We have to put slight negatives in as well. Food prices year on year are really high. Over 16% is the food price inflation. So again, we need to see that come down in 2023 as well. But overall, very positive, the fact that inflation is now peaked, and we believe interest rates are now getting to the point where the Bank of England is feeling they don't need to raise them as much going forward.
Today, the Bank of England increased base rate by 0.5% in line with market expectations. This takes the base rate to 3.5%, which is the highest we've seen since 2008. Yesterday's lower than expected inflation figure will have been a welcome development to the Bank of England policymakers and shows that the previous increases are starting to take effect. As this was expected by the markets, the announcement has had limited impact on the FTSE. The market currently expects another increase of 0.5% to the base rate in February. Inflation may now have peaked, and as we see inflation data fall, we would expect this to be positive for investments.
When we look across in America, which dominates all world markets, this is where all world markets look to see what's happening, and if positive data comes out with regards to inflation, markets will go up early part of this week after a 5-day consecutive losing streak on the US markets. the news came through that inflation had gone down again, which is absolutely fantastic. The markets went up on the back of that news. The markets are still jittery and volatile on the basis that they know there's a recession coming and they don't know how deep that recession is going to be. The Federal Reserve Chairman spoke last night about inflation and using interest rates to curb inflation, and he is now confirming that interest rates aren't going to go up as high as previously thought. They do believe the pivot, as they call it in the US, is going to be around about 5.1% of where rates are going to go to. But they've certainly stopped raising rates by 0.75 at the time of this latest rate increase was 0.5. What we would be hoping for in February, that it's 0.25. You're now starting to hear comments like, well, it'll take a full 18 months for these interest rate rises to really affect monetary policy. So therefore, they're now looking ahead and saying, well, how will that affect things in 2024? A criticism of the Federal Reserve has been that they were looking in the rear-view mirror to predict what to do going forward. And obviously, if you were to drive any car looking through the rear-view mirror only, you're going to crash. And that was the fear with it. So it's positive that the Fed are now saying, well, let's look forward as to what these rate rises may do. They are still regarded as being quite hawkish. They want to increase them, but certainly not as aggressive as they were previously, which is great. In his closing comments last night, Mr. Powell, the head of the Federal Reserve, said that their long-term target of 2% inflation is still the road that they are going down. I'd be amazed if they get down to 2%, but anything less than 4% in the short term is going to be fantastic news, and markets will absolutely love that. But they're saying they want to bring it down in a coordinated fashion, in a more thorough, thought-out way of doing it. So I was pleased with the update we saw last night. Another really good story that we saw happen this week, I know I'd mentioned it a good few weeks ago on one of the updates, was China reopening from its COVID lockdown measures. You might have seen in the news there was big protests in China a few weeks ago. Apple had said that their factory across there was not going to produce as many mobile phones because the Chinese government had imposed more restrictions and more lockdowns. Well, quite surprisingly, the Chinese government has effectively gone full circle and pretty much ended all COVID restrictions. I think they're now of the opinion that if you look across to Europe, to America, to the West, that we opened our economy, opened restrictions, and people weren't dying left, right and centre. They have vaccinated most people 3 times, so they've decided to fully reopen. And if you look on the chart on the screen now, you can see that China is hoping for much more positive GDP in 2023. It was around about 3.2% in 2022, which is their slowest growth rate since the 1970s. America and the UK and Europe would love to have 3.2% growth per annum. China's had that for a long time because of how they emerged back to be this massive superpower. And now what they're hoping is in 2023 that GDP rebounds to at least 5% once all these COVID policies are removed. This is great news for the rest of the world because it's freeing up and opening up more and more supply chains. A lack of supply of all of the key components, goods, products, whatever you buy from Asia, from China, if we can get them cheaper, it brings the inflation numbers down, and that's fantastic for everyone. And hopefully this is a very positive story for all of us.
Chris has covered some good positive news stories there. Again, we look at all news stories and we reflect on what that means to our clients. Some clients have been talking to me about the housing market. As you can see from this chart, there is predictions that house prices will fall in 2023. The UK housing market is forecast for potentially the worst drop in house prices since the 2008 financial crisis. Nationwide's Chief Financial Officer, Chris Rhodes, said the worst case scenario is 30% drops, but an 8% to 10% decline is more likely. That's very similar to a figure I heard from an economist recently who said anywhere between 8 and 18 is where he feels that markets might fall in terms of house prices. I think talking to landlords who are clients recently, they say actually it's a very regional process and they see quite a lot of strength in the property in our region. But when we look at London, that might be a different story. So I think it's all taken with a pinch of salt, but it helps put the context of if you see a headline in the news that says we're in the UK housing market slowdown, actually will that affect your underlying investments? Part of us having diversified portfolios for clients means you're not overly exposed to any one sector, such as property. And often when you see property in your portfolio, that's more commercial property, which might be Amazon warehouses and infrastructure rather than property in your traditional sense. The biggest driver in relation to this UK housing market slump is the surge in interest rate rises, which has put in mortgage costs up. So as you would expect, actually the cost of servicing that debt becomes more expensive over time. The UK mortgage rates are forecast to remain near 5% until potentially 2028, with people coming off fixed deals as we go through that process. Looking at the UK in general, it's certainly been a wild ride for the pound. In this last year, we've had 3 prime ministers, 4 finance ministers and 1 ill-fated budget that drag the pound within an inch of parity versus the US dollar. And if you look at this chart on the screen now, you can see how volatile that has been. When we were talking to economists recently, they were saying, well, actually, the outlook for the UK economy isn't great for 2023. And as you see on this next slide, there's a view that the UK economy may not grow again until late 2023. However, they were keen to point out that the UK economy isn't the same as the UK stock market and isn't the same as investments. There will be companies, as you would expect, still making profits and still generating returns within the UK. And actually, when we look at the FTSE 100 as we've presented in the past, a lot of those earnings are overseas earnings. So when you see news stories about 2023 and the economy, it's important to separate them in terms of what the economy needs and what the investment markets mean for yourselves. Looking at US returns, this chart shows the S&P 500's annual drawdown, so that's the furthest the market would have fallen in a year, compared to the blue, which is where the market finished the year. So as you can see, stock market falls aren't a rare occurrence. Going back to 1980, on average, the US stock market fell by 14% each year, but the average annual return was positive of 11%. In 2020, the S&P fell by 34% at one point, but it finished the year 60% higher than the 1st of January. So this helps present that idea that it's important to stay invested and stay in the market, because even though there's short-term volatility, the end result is often positive for equity markets. We've recently heard from Royal London, and we have a number of client portfolios who invest with Royal London. It's interesting to look at their tactical positions as we move into 2023. As you can see on this chart, they're overweight in equities and they're overweight in corporate bonds. They've recently made the decision to move away from commodities that they had banked some profit, but they're moving that and reinvesting that into equities. The main reason when they were talking to us that they're focused on being overweight in equities is that actually with global inflation, equities are the asset class that's best positioned to be inflation proof. And actually, as we see global inflation peak, they see that equities is going to have a better time through 2023. The charts on your screen now show the asset allocation position of one of the Royal London funds. This is the Government Portfolio 5 fund as an example. And as you can see, the tweaks they've made between the 30th of June and as they move into the 30th of November, this is what they're doing. They're constantly managing the investments on behalf of clients in order to look at where the world is positioned and see where they should move things around. We are glad that they've made the decision to increase the exposure to the US, because that's in keeping with a number of reports and a number of analysts that we've been hearing from, that the US has more opportunity to grow in 2023, and that's what we want for our clients. The chart on the screen now is looking at the UK stock market focused on the oil, gas and coal section, and also the total return of the FTSE All-Share in general. The main reason to highlight this is to show that it's different component parts of an indices that drives growth. So for us, it's always important to have a diverse portfolio, because some elements of that portfolio within the equity space and even from the wider bonds, property and alternative investments, they're all doing something within the portfolio to add value for yourself, whether that is managing risk or driving performance. If someone made the decision to be fully invested in oil and gas and coal through 2022, they would have had a higher return, but actually, that can be a volatile ride, and that might not be the best positioned place next year or the year after, which is why we need a diverse portfolio for our clients. When we look at the stock market indices performance in quarter 4 of 2022, you can see that the FTSE 100 has had a positive time. When we look at the MSCI World in red and the S&P 500 in green, it has been a volatile time, but as you can see over this quarter, it's looking like it's going to finish in positive territory, which is encouraging. When we look at the stock market indices performance year to date, again, it's certainly a very volatile journey for you there. The FTSE 100 in blue finishes above in positive returns, and the S&P 500 and the MSCI World are finishing in negative territory. But again, it's been a volatile journey, and at different times it would have been better to be allocated to different global indices, which is why moving to have discretionary permissions for some of our portfolios has been a positive step forward for us going forward. When we look over a 3-year period, when you zoom out, the volatility looks less extreme, and as you can see, both the S&P 500 in green and the MSCI World in red have performed very well over long term. The FTSE 100 hasn't performed quite as well, but again finishing in positive territory over 3 years. We always like to invite clients to have a seminar with us. We've got a date of Friday the 27th of January, and that's going to be at Durham Cricket Club, and we look forward to seeing as many of you there. Full details of that will follow soon. Christmas opening hours. Everyone's worked very hard at Wealth of Advice this year, and the office is closed for Christmas on the 23rd, reopening on the 3rd of January. As always, if anyone's got any queries or any urgent requests in between, if you do message your advisor, if they can help, they will. But if not, we look forward to seeing you all in 2023. Hope you have a great Christmas and a great New Year with your loved ones.